Welcome to an introduction to employer obligations, who's an employer, and deductions. This is part 1 of our series. It's important to know who must register as an employer and the deductions employers must make. Feel free to pause or review as you need to. We will look at who needs to register as an employer, what your employer obligations are, and the deductions employers make. Employers are businesses that engage someone to work in their business. It's up to the employer to understand who's an employee and who's an independent contractor. Anyone that works for you, where you have control over what, where, and how the work is performed, could be an employee. If you're unsure, we have a questionnaire on our website which will help you work this out. It's an IR 336. If you hire a self-employed contractor, you may still need to deduct tax from their payments. There's a list of contractors that must have their scheduler tax deducted from their income. It's found on our website and on our IR 330C form. One of the key responsibilities for employers is to make deductions from wages and from scheduler payments made to contractors. You must keep wage records and budget for PAYE and ACC. You'll also need to ensure your employees complete their tax code form and any KiwiSaver forms if they're eligible. Employers must also file employment information returns on a payday basis. Here are the types of deductions you'll need to deduct from wage payments. We'll cover most of these in more detail in the following slides. There may also be times when we request you make additional deductions from an employee's income, for example to cover their arrears. If this is the case, we'll send you a letter with the details. Employers must deduct tax from salaries, wages, and scheduler payments to contractors. Employees must complete a tax code declaration form with their IRD number and tax code and give it to their employer. Employers hold on to the IR 330 and use the information provided to work out how much tax to deduct. If you hire a contractor that receives scheduler payments, you'll deduct scheduler tax. The list of businesses that receive scheduler payments is on the IR 330C form. If the contractor's activity isn't on the list, then you don't need to deduct any tax. If the activity is on the list, the contractor must complete the IR 330C form and give it to you. You keep this form with your records. Scheduler payments are taxed at a flat tax rate, and the IR 330C tells you which tax rate applies. If a contractor holds a current certificate of exemption, you won't need to deduct any tax. They must show you the exemption, and you'll need to take a copy. It's important to know your KiwiSaver responsibilities as an employer. When a new employee starts, you'll need to check if they meet the automatic enrolment criteria. Generally, if you're a New Zealand resident and aged between 18 and 65, you must be enrolled into KiwiSaver. The full criteria is on our website. If an employee must be enrolled, you'll need to give them the KS2 enrolment form and start KiwiSaver deductions from their first pay. The employee can only opt out of KiwiSaver between week 2 and week 8 of employment. If they want to opt out, they need to complete a KS10 form and give it to you. You hold on to all of these forms in your records. KiwiSaver members choose to contribute between 3% and 10% of their income to their KiwiSaver fund. Employers must contribute 3% to the employee's fund. You can choose to contribute more if you want to. Employers' contributions have tax deducted. The tax is called ESCT, Employer Superannuation Contribution Tax. Note that you don't make KiwiSaver contributions for payments to contractors. Employers need to work out how much tax, or ESCT, to deduct from their employer KiwiSaver contributions. The rate depends on the employee's gross salary and wages for the year, plus the total employer contributions. If the employee hasn't been with you for a year, our website has details on how to work out their ESCT rate. Search ESCT to find the information. The other option for deducting tax on employer contributions is to add your contributions to the employee's wage and deduct PAYE. This can only be done if the employee agrees. Here are the different ESCT rates and thresholds. Work out the ESCT rate based on the total wages plus employer contributions for the year. For example, if an employee earns $40,000 per year and the employer KiwiSaver contributions are $1,200, then the combined total is $41,200 and the ESCT rate will be 17.5%. Once you've worked out the ESCT rate, you'll enter this into the PAYE calculator. The calculator will tell you how much ESCT to deduct from the pay. The ESCT rate stays fixed for the year, regardless of any change in salary or wages. If you have an employee with a student loan, deductions are made from their salary and wages to repay it. The employee will add SL to their tax code. When you use these details in the PAYE calculator, it'll tell you how much the student loan deductions are for that pay. In some situations, the usual deduction rate might not apply. Your employee might have given you a certificate with a specific deduction rate, or even an exemption from deductions. Follow the rate on the letter for the period of time specified. At the end of the certificate period, you'll go back to the usual deduction rate, unless the employee provides a new certificate. You might also receive a notice direct from Inland Revenue for student loan deductions. If you do, you must follow the requirements of the letter. If the employee disagrees, they'll need to contact Inland Revenue.